You walk past them every day on your way to work or the grocery store. Massive glass towers standing silent in the city center. Office parks with empty parking lots. To you, they look like buildings. To the global financial system, they are ticking time bombs disguised as steel and concrete. And the timer on those bombs is set for exactly 2026. Inside the global economy breaks down the hidden forces shaping the world economy. Most people think the 2008 financial crisis was about houses. It was about people buying homes they could not afford with mortgages they did not understand. But the next crisis will not be about the house you live in. It will be about the office you used to work in. Right now, there's a $1.8 trillion wave of commercial real estate debt crashing toward the shore, and the seawall meant to stop it is made of paper. We are walking toward a maturity cliff that is unlike anything we have seen in modern history. And the scary part is not that the buildings are empty. The scary part is that the banks are pretending they are full. To understand why 2026 is the year the math breaks, you have to understand how commercial real estate actually works. It is nothing like your home mortgage. When you buy a house, you get a 30-year fixed rate loan. You pay the same amount every month for 3 decades, and at the end, you own the house. Commercial real estate does not work that way. When a developer buys a skyscraper or a shopping mall, they do not get a 30-year loan. They get a 5-year loan or maybe a 10-year loan. The payments are calculated as if the loan lasts for 30 years. But at the end of that 5 or 10-year term, the entire remaining balance comes due all at once. This is called a balloon payment. Nobody actually pays off the balloon payment with cash. That would require hundreds of millions of dollars. Instead, they simply get a new loan to pay off the old one. They refinance. This system works perfectly as long as property values go up and interest rates stay low. It is a perpetual motion machine of debt. You borrow cheap money, buy a building, wait 5 years, and then borrow more cheap money to pay off the first loan. But in 2026, this machine is going to jam. We are facing a convergence of 3 distinct disasters that have never happened at the same time before. First, you have the interest rates. Most of the loans coming due in 2026 were originated in 2016 or 2021. Back then, interest rates were near zero. Developers were borrowing money at 3 or 4%. Today, rates for commercial loans are double that. This destroys the math of the building. Let us look at a simple example. Imagine you own an office building that brings in $1 million a year in rent. Your loan payment is $800,000. You're making a profit. Life is good. But now your loan matures and you have to refinance. Because rates have doubled, your new loan payment is $1.6 million. But you still only collect $1 million in rent. You're now losing $600,000 every single year just by keeping the lights on. The building is technically insolvent. It is worth less than the debt attached to it. The second disaster is vacancy. We all know that remote work changed the world. But we have not really processed what it did to the value of office space. In major cities, vacancy rates are hovering near 20%, but the real vacancy rate is actually much higher because of something called shadow vacancy. This is space that is technically leased, but empty. A tech company might have signed a 10-year lease in 2019. They are still paying rent, so the building looks full on paper. But no one is going into the office. When that lease expires in 2026, that company is not going to renew. They are going to cut their space by half or leave entirely. That is when the real vacancy hits. So you have costs exploding because of interest rates and income collapsing because of vacancy. This brings us to the third disaster, which is the maturity wall itself. In 2026, an estimated $1.8 trillion of these loans come due. This is the bill coming due for a decade of cheap money. You might be asking, if this is so obvious, why hasn't it crashed yet? Why are we not seeing bank failures on the news every night? The answer is a strategy that bankers call extend and pretend. This is the open secret of the banking industry right now. When a borrower comes to the bank and says, "I cannot pay off the balloon payment," the bank has a choice. They can foreclose on the building, take the keys, and try to sell it. But if they do that, they have to admit the building is only worth half of what they loaned on it. That means the bank has to record a massive loss. If they take enough of these losses, the bank itself goes bankrupt. So the banks do not foreclose. Instead, they look at the borrower and say, "We will give you another year. We will modify the loan. We will pretend that the building is still worth what you paid for it, and we will extend the maturity date." They are kicking the can down the road, hoping that by some miracle, interest rates will go back to zero, or everyone will suddenly decide to return to the office 5 days a week. They are buying time, but time is running out. The problem with extend and pretend is that it does not fix the underlying rot. It just hides it. It creates zombie buildings that are alive on paper, but dead in reality. And the regulators are starting to crack down. They are looking at bank balance sheets and asking hard questions about why they are valuing empty office towers at 2019 prices. When the regulators force the banks to mark these assets to their true market value, the extend and pretend game ends. And this is where it gets dangerous for you. You might think you don't own any commercial real estate, so this is not your problem. But you do own it. You just don't know it. The biggest holders of commercial real estate debt are not the giant banks like JP Morgan or Bank of America. Those banks are too smart. They saw this coming and offloaded their risk years ago. The bag holders are the small and mid-sized regional banks. These are the banks that lend to local businesses and hold your deposits. They are loaded to the gills with commercial real estate loans. If you look at the balance sheets of regional banks in the United States, some of them have 40 or 50% of their loan book tied up in commercial real estate. When these loans default, it wipes out the bank's capital. We saw a preview of this with Silicon Valley Bank and Signature Bank, but those were specific cases of mismanagement. What is coming in 2026 is a systemic wave of defaults that hits hundreds of small banks at the exact same time. But the contagion spreads even further than regional banks. It goes straight to your retirement. Pension funds and insurance companies are massive investors in commercial real estate. For decades, they loved office buildings because they provided steady, safe income. It was supposed to be the boring part of the portfolio. Now it is the toxic part. If you have a pension or a 401k, a significant chunk of it is likely exposed to this asset class. When the write-downs happen, your retirement fund takes a hit. There's another player in this game that no one talks about, the private credit industry. These are unregulated lenders who stepped in when the banks pulled back. They have been lending billions of dollars to desperate real estate developers at very high interest rates. They took the risks that the banks refused to take. And now they are sitting on a pile of bad loans that have no government backstop. If the private credit bubble bursts, it creates a liquidity black hole that sucks cash out of the entire economy. So what actually happens in 2026 when the wall hits? It starts with capitulation. Developers will simply walk away. We are already seeing this. Massive investment firms like Brookfield and Blackstone have already walked away from office towers in Los Angeles and New York. They simply mailed the keys back to the bank and said, keep it. It is a strategic default. They did the math and realized the building is underwater, so they cut their losses. When the big guys walk away, it sets a new price for the market. If a tower that sold for $500 million in 2019 sells for $200 million in 2026, that effectively reprices every other building in the city. Suddenly, every bank has to write down the value of their collateral by 60%. That is the moment of insolvency. That is when the credit crunch begins. A credit crunch is worse than a stock market crash. In a stock market crash, you lose paper wealth. In a credit crunch, the plumbing of the economy stops working. Banks stop lending to everyone, not just to real estate developers, but to small businesses trying to make payroll or families trying to buy a car. When banks are scared, they hoard cash. The velocity of money slows down and the economy grinds to a halt. This is the deflationary shock that follows the inflationary boom. The cities themselves will also pay a heavy price. Commercial real estate taxes are a huge source of revenue for local governments. In places like New York or San Francisco, property taxes on office buildings fund the police, the schools, and the sanitation department. When the value of those buildings crashes, the tax revenue crashes with it. We are looking at a future where cities are forced to cut services or raise taxes on residents to make up for the hole in the budget left by the commercial real estate collapse. It is a doom loop where higher taxes and worse services drive even more people and businesses out of the city, pushing property values down even further. The scary thing about the 2026 debt cliff is that there is no easy fix. The Federal Reserve can print money, but they cannot print tenants. They can lower interest rates, but they cannot force people to commute an hour a day to sit in a cubicle. The structural shift in how we use real estate is permanent. The financial instruments built on top of that real estate are obsolete. We are witnessing the slow motion demolition of an asset class that was once considered the gold standard of investing. For 50 years, owning a Class A office building in a major city was the safest bet you could make. Now it is a liability. The transition from the old world of office work to the new world of hybrid work is not just a cultural shift. It is a multi-trillion-dollar repricing event. And the bill for that transition is coming due in 2026. Some people will tell you that this is an opportunity. And for the ultra-rich, it is. Distressed asset funds are already raising billions of dollars to buy these buildings for pennies on the dollar. They will swoop in after the crash and pick up the pieces. But for the average investor and the average taxpayer, this is not an opportunity. It is a hazard. You need to look at your own exposure. Who do you bank with? Is it a small regional bank with heavy exposure to local commercial real estate? If so, you might want to diversify. Look at your investment portfolio. Do you own REITs or real estate investment trusts that are heavily weighted toward office space? It might be time to reconsider the safety of that dividend. The narrative you will hear from the mainstream media is that the worst is over. They will point to a few buildings getting refinanced or a few companies calling workers back to the office and say that a recovery is here. Do not believe it. They are looking at the surface. Underneath the surface, the math simply does not work. The $1.8 trillion debt wall is a mathematical fact. It cannot be spun. It cannot be wished away. It must be paid or defaulted on. We are living through the end of the extend and pretend era. The pretending is almost over. The reality is about to begin. The glass towers that define our skylines are no longer monuments to our economic power. They are tombstones for a financial era that has already died but just hasn't fallen over yet. The crash of 2026 will not be loud and fast like the crash of 2008. It will be a slow grinding suffocation of credit and growth. It will reshape our cities, our banks, and our economy for the next decade. And the only way to survive it is to see it coming before the rest of the world wakes up. Keep your eyes on the regional banks. Keep your eyes on the vacancy rates. And most importantly, keep your eyes on the calendar, because 2026 is coming and it is bringing the bill with it.